And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Monday. It is also the last day of September, which means that my wife was putting out Halloween decorations all weekend. So we are Halloween ready at this moment. So she's very excited. Her favorite time of the year has now started, which is every holiday between now and New Year's, right? Because she gets to decorate. So this is all about decorating her new house. So she's very happy. She's very content. Amazon's been very busy lately. So anyway, it's all good. But that also means that today is the last day of September. It is also the last day of the quarter, which means that millennial earnings season starts tomorrow. And we will start getting, at the end of this week, we'll start kind of getting some of the initial kind of blushes of earnings. And then we'll have mostly the major banks up first, followed by the big tech companies, and then we'll wrap up with, kind of the miscellaneous industrials and things after that. And we'll have some retailers along the way. Of course, all this will be important to kind of get a pulse on just how good the economy is doing. But if you take a look at economic data over the last couple of weeks, analysts are currently ratcheting up their expectations for GDP through the course of this year. We're currently looking at about 2.4% annualized growth for the economy for 2024. But recent economic reports, personal consumption, retail sales, etc., have all been okay. They're not stellar, right? But they're not terrible either. And this certainly should put to rest a lot of these kind of headlines about inflationary concerns. Should put to rest also a lot of these recession concerns that are like, oh, we're having a recession. There's really no evidence of that right now. And again, while there are certainly some indicators suggesting that a recession risk is still alive and well, there's no evidence that we're getting there just yet. Now, that doesn't mean that we're not going to wake up, in 6 months or 9 months from now, and then they go, oh yeah, the recession started 6 months ago. That happens. But at the moment, there's certainly nothing indicating that. And again, that's why markets continue to do well. At least at this point, markets kind of said, pushed up. We're set all-time highs on Friday. So, everything's fine in terms of the markets. The economy's doing okay. But importantly, all of this, right? None of this matters. And this is something we'll be talking about tomorrow. No matter what your thesis is of, what your personal outlook is, bullish, bearish, anywhere in between, all that matters are flows. Is there money coming into the market, or is there money leaving the market? And right now, money is literally pouring into the financial markets. Global fund managers, their positioning in the U.S. is now 30% of their portfolio. So we've got a huge amount of monetary inflows coming in from foreign investors into the U.S. U.S. investors are currently at record allocations in terms of equities in their portfolios. So again, just kind of no matter where you look and no matter how you measure it, the amount of money just kind of flowing into the markets has just been absolutely phenomenal over the course of the last couple of years. And this is despite concerns of higher interest rates, weaker economic growth outlooks, debts, deficits, all these things. So again, when you step back from, kind of this, view of the markets and kind of the other headlines, things that are going on, it's fine. The function, the one thing that drives the markets higher is, right, because markets are supply and demand driven, is simply flows. And flows have been exceedingly strong. Speaking of exceedingly strong flows, China off to the moon here. China is now the most overbought that has been in ever on record. It's had a 40% increase in just a couple of days here because of this Chinese stimulus. Of course, Chinese tech stocks were extremely beaten up. They've had a huge surge over the course of the last week because of Chinese stimulus. But now those stocks have reached it's amazing how overbought Chinese equities are right now. So if you have missed that trade, you have missed that trade. You cannot buy that here. But it's just from a technical basis alone, that surge higher has been just absolutely phenomenal. Let's talk about what you need to know before the bell this morning as we wrap up the month of September, get ready to kick off millennial earnings season. Of course, that's where we lower the bar so everybody can beat earnings estimates. Everybody gets a trophy, of course. That's going to start again as we get into October. Also, that means that buybacks are going to be completely blacked out here shortly. So there's been a few buybacks coming in, but again, that's going to completely go away here over the next 2 weeks until the end of the month, right? So at the end of October, those buybacks will start to open back up again as we get through earnings season. But overall, just talking about the markets in general, again, nothing wrong with the markets. We had this correction back in August. It's just been a rampage of buying since that Japanese yen carry trade. So whatever reversal in the Japanese yen carry trade that we got done in terms of pulling off that margin, that's been completely reversed. So it's just been a very strong rally. Now, looking at this, we're now getting very overbought relative to the 50-day moving average, the 20-day moving average, et cetera. Really, those deviations from those moving averages are getting, fairly decent here. And on a weekly basis, this is a weekly chart of the S&P 500. On a weekly basis, we're getting very, very deviated from long-term moving averages. And so again, as we talked about before, we've warned about this before, is that when you get these big deviations from even the 20-week, the 50-week, or the 100-week, you're eventually going to get a correction that pulls you back towards those moving averages. Again, it's just simply a function of how deviations work. We've seen this repeatedly kind of throughout the history of the markets, but right now, again, markets are certainly, pushing up some overbought levels, as we noted last week. Certainly have some negative divergences going on in both momentum as well as relative strength. But again, if earnings come in strong here over the next couple of weeks, that should help lift earnings. Outlooks are going to be the most important thing. There's a very, very high correlation between the annual rate of change in the S&P 500 and the underlying year-over-year change in earnings. If estimates are graduated higher as we go through earnings season, if earnings season comes in as well, companies talk about strong outlooks, et cetera, and analysts start to ratchet those forward earnings up, that's going to be a lift to markets. That's going to be supportive for markets. So again, it's not going to be just the earnings report that are important to pay attention to here over the next month. It's going to be the outlook for those companies in terms of spending, consumer deterioration or not, outlooks, and particularly when we get into technology, the outlook for AI, what's happening there. That's going to be a huge driver for markets, and particularly the large cap stocks, kind of really across the board. So, again, it's not going to be the number, just whether or not they beat estimates is not going to be the issue. It's going to be the outlook. The other side of this, of course, is, and we touched on this last week, but oil has been getting absolutely thrashed here over the last really kind of 5 weeks. In fact, there's been a massive amount of short selling in oil over the last 5 weeks. So you've got you have one of the largest short position in 5 years right now on oil stocks. Now, again, big short positions on oil tend to lead to at least short-term recoveries as you get a squeeze in oil prices. If oil prices move up for any particular reason whatsoever, you're going to get a move higher. But again, you've had just a tremendous amount of selling in oil prices. So again, there's a getting to be, and again, you have to be patient with this right now. We're not quite set up for it yet, but it looks like we're getting set up for a fairly decent reflexive rally in energy shares if we get a rebound in oil prices over the course, as we kind of get ready to head into the winter months. But again, this is just something where don't do anything with this just yet. There's not any evidence that this selling pressure is over. But oil is getting very oversold. Energy stocks are getting oversold in general, and that's typically been a really good setup for a reflexive rally. That's not necessarily a long-term trade, but a good opportunity just for a reflexive rally in those shares. Okay, that's what you need to know before the bell this morning. We'll come back and talk about the great confidence dichotomy right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, welcome to the show this morning. It is, of course, Monday. So, I have 2 dogs, and one of them is, named Gunner. The other is named Sniper, and my kids named them. So, Gunner is the lover of the group, right? He just loves to cuddle, loves to, just be with somebody, right? He just wants to be super friendly, acts tough, but is not tough at all. And so ever since he's been a puppy, if you lay down on the ground, he will literally run to you and put his head down and then like crash into you and gently crash into you and kind of throws back up next to you to snuggle. He just wants to cuddle with you, kind of be in dog pile. And so, whenever he's looking lonely, I'll lay on the floor and he'll come running over to me and we'll spend some time together. And well, he's getting older and he can't see as well as he used to. So judging distance becomes a problem. And now when I say he runs to you, I mean, it's a literal full-on sprint. If you lay on the floor, he will full-on sprint towards you. The problem is he can't see and judge distance as well. And you'll notice he busted my lip open this weekend. Because he puts his head down and it just literally crashed into me full speed, and his head is hard. So he busted my lip wide open. So if you wonder what happened to my lip, it wasn't my wife. I did everything she told me this weekend. It was literally my dog. So, but anyway, like I said, he's going on 12, so he's getting up there, but still tries to keep up with Sniper's 3, almost 4. So he tries to keep up with Sniper all the time, but he does a good job. About 28 pounds. So yeah, they're both. Yeah, so Gunner was a ripoff. So I used to have this dog when I was younger. He was half Labrador, half German Shorthair Pointer. And so he was black and white, spotted like a dairy cow, weighed about 60 pounds. Great hunting dog, right? So, I mean, this dog was awesome to go hunting with. Super smart. And so when he passed away, my wife and I, he'd passed away, many years ago. And so for a long time, I didn't have a dog. And so when my wife and I got married and we had settled into a house with all the kids and obviously 12 years ago. My wife was like, we need to get a dog. So I went online to the animal shelter. I was looking for a rescue. And I'm scrolling through all the pictures, and, here comes this dog. It's black and white spotted, just like a dairy cow. And I was like, it's Jake. He's reincarnated. And so I'm going to go get this dog. And so I go down to the pet shelter and to the rescue, and I adopt this dog. And turns out he's not half Labrador, half German Short-Hair Pointer. He's half Terrier, half German Short-Hair Pointer. So he's half the size of my previous dog and about half as smart. So he's also deaf in one ear, and his brothers and sisters all had parvo. He was the only one that survived out of his litter that came up, but he's also the runt of the group. So yeah, anyway, great dog, super wonderful. Does not listen to a thing you say, except when it's something he wants to do. So if you say walk, treat, whatever, he's all there. He will listen to you and do whatever you want. And outside of that, forget it. So he's going to do his own thing. Kind of like my wife. She doesn't listen to me either. So anyway, all right. If you're in the chat this morning, please like the stream. We appreciate it very much. Just click that like button. It does help the algorithms push our channel out, and that does help us a good bit. All right. Interesting kind of development over the last, few months in particular, as, when you take a look, and I was kind of talking about this other, is like, when you look at the markets are doing things that kind of belie the underlying views on a lot of things, right? So if you take a look at consumers and things that are going on, whether it's, just in the chat right now, they're talking about inflation and the cost of a Subway sandwich, and absolutely true. So there's a big difference between what's going on financially in the markets and what seems to be going on in the rest of the world. And this is what I'm saying, is that, that no matter what you think it is, and again, this is the subject of tomorrow's article that we'll talk about tomorrow, but it really doesn't matter what else is going on right now. It's all about flows. And there's only one place in the world you want to have your money right now, and that's in the U.S. For a whole variety of reasons. The rest of the world isn't safe. But the U.S. is where all the action is. And so if I've got money to invest, I'm going to invest it in the U.S. And so we're just getting massive inflows from foreign investors, domestic investors, and the amount of money that's out there is just absolutely kind of mind-boggling as to just how much money is just sloshing around in accounts. I mean, there's still over $6 trillion in money market accounts sitting out there. Just think about the magnet. Now, not that money will never come back into the market, by the way. There's always like this, there's money on the sidelines. That is not true. There is no money on the sidelines, but there's a lot of money sitting out there that isn't invested right now. And you take a look at the amount of private, kind of dry powder that private capital has. It's huge. Equity funds, hedge funds, mutual funds. It's just huge. The amount of capital that's sitting out there. It's like, man, where'd all this stuff come from? Everybody's talking about how there's no capital, but it's just literally sloshing around kind of everywhere you look. And so, this has been one of the big drivers behind the market, has just been, liquidity. But again, it is interesting. And again, so, Brent, can you bring up this chart for me? So we run an allocation model that's based on allocation. So, people often send me the CNN kind of fear greed index, and that's the problem I have with the CNN fear greed index is that you use it to measure the S&P, but one of the components is the S&P. So it kind of skews the data a bit. And so what I wanted was a measure, and again, it's a lot of sentiment in that gauge, which is fine. There's nothing wrong with the sentiment. But I wanted a gauge that was more representative of how investors are investing versus how they feel about investing. Now, again, I also included sentiment because that's important. But this index does not include any markets in it. It's only how are investors feeling about the market and how are they actually allocating to the markets, because those two can be different. I can feel very bullish but not be allocated to the market, or vice versa. And we've seen periods in time where that's been the case. But so what this gauge looks at is when are investors heavily allocated to the markets, and that's now. So what this gauge shows you is that every time you get really kind of above 80, and particularly when you start getting into the 90 percentile range, that has typically been close to short-term market corrections, market peaks, etc. And it just kind of makes sense, right? When everybody's in the market, as Sam Stovall once said, is everybody's bought, who's left to buy, right? And so it just kind of makes sense. Well, and that's kind of where we are right now. But again, back to this whole issue is that everybody is very optimistic about the overall market. And again, this is important. As I said earlier, the one thing to pay attention to is earnings. Earnings come from economic activity. And so there's a high correlation between earnings growth and GAAP earnings. Obviously, if the economy's growing, that generates more revenues for companies. And if the economy's growing as it is now, then earnings are going to improve. And so we went through a period where earnings growth had, economic growth slowed down in 2020, and then we've been recovering since that. And so we're seeing economic growth kind of pick up here recently, and that's translating into higher earnings growth for companies. And so companies are reporting better earnings. And not surprisingly, as I said at the beginning of the show, there's a very high correlation between the annual growth rate in the S&P 500 and the annual growth rate in the denominator of valuations, which is earnings. So as long as earnings are improving and earnings are growing, markets are going to grow along with earnings. And it doesn't matter what else you think is going on out there. That's it, right? I mean, markets price off of earnings because that's valuations. We talk about valuation all the time. Like markets are so expensive. Look at the valuations. Well, as long as the E is going up, we're okay because markets are going to price optimistically off of forward earnings because markets don't want to miss out on earnings. Now, when something happens that grossly reduces that forward estimates of earnings, prices of markets are going to contract at that point. But you need some event that tells traders to reprice for lower earnings. And right now, we just don't have that going on. But here's what's important. Consumer confidence is very important. Why is consumer confidence important? Because consumer confidence relates to how investors and individuals are spending money. And consumer confidence, and this is the Conference Board measure of consumer confidence, versus the S&P 500. And as you can see is that consumer confidence has been declining really ever since the peak of 2019, but yet the markets continue to ratchet higher. And this is an interesting dichotomy, but you have to break this down. And this is what we'll talk about when we come back next. There's a really interesting dichotomy going on now in consumer confidence and why the markets are rallying. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my kids know that I do radio, but they don't listen to it or anything. This guy sees me in the airport. So now my kids think, like, oh my gosh, my dad's really
famous.
He's famous, right? Yeah, it's awesome. He's famous.
The Real Investment Show podcast.
So we get in the car and we find a Red Robin. It's packed. We've been there maybe 5 minutes. He comes over to me. He's like, come on, I got you. Puts us in a private room at Red Robin.
You know you've made it when you're an A-lister at
Red Robin. Exactly.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And good morning. Welcome back to the show. So, talk a little bit about consumer confidence. And again, there's been a big deviation between the consumer confidence of consumers and what's going on in the financial markets. It's been a little bit of a head scratcher, right? And it's like, well, if consumers are not very confident, then why are stocks doing so well? Because normally they track each other pretty closely. And so I create a confidence index, and we'll get into this in a minute, but there's two measures of consumer confidence. There's the Conference Board measure, which is the official measure of consumer confidence, and then there's one from University of Michigan. And those two have been giving us different readings now. Normally they're fairly close to each other, but now we've been getting different readings even from those. So I created a few years back a composite of both those measures, so we just have a broader view of what's going on with consumer confidence. But before we get there, let's go look at a couple of interesting aspects of what's going on in consumer confidence. So consumers, this is from the Conference Board. So consumers right now, there is a very sharp increase in what's called jobs hard to find, all right? So jobs not so plentiful, right? In other words, having a hard time finding a job. So they're very concerned right now about losing their job, because if they lose their job, trying to find a job is not so easy. Now, that certainly doesn't bode well for the economy, right? If I'm worried about losing my job, or if I'm worried about not being able to get a job, then I'm not going to spend a lot of money in the economy. Kind of just makes sense. So that's not great for economic growth. However, you ask these same people, okay, so what do you think about the jobs market? Man, it's tough. I'm really worried about losing my job. Okay. Well, what do you think about stock prices in the next 12 months? Oh, that's great. right? Stock prices are going to soar off to the moon in the next 12 months. In fact, consumer confidence in stock prices in the next 12 months is at some of the highest levels on record. In fact, the last time we were here was in 2018, right after Trump passed the Tax Cut and Job Act. And consumer confidence in the markets absolutely just went straight off to the moon into 2019. So it's interesting, right? I'm not optimistic about the economy, and again, like all you all my friends here in the chat channel that I'm watching scroll by, they're super bearish on the economy, right? Inflation, stagflation, the recession. It's just everybody's very concerned about the outlook, right? Listen to Adam Taggart, world's coming to an end. But ask them about stock prices, it's great. Now, there is a couple of things to note about this, right? This dichotomy that's going on. It's a very interesting thing because, again, earnings come from consumer activity. So if consumers aren't operating in the economy, earnings are going to be impacted, which is going to impact market outlooks because, again, as I showed you earlier, there's a big correlation between earnings growth and stock price growth. So this is the Consumer Confidence Composite Index, right? So now this is an index of both Conference Board and University of Michigan. And as you can see, while confidence has improved somewhat from 2023, it's not improved a lot. And there's this massive gap right now between the market and what's going on in confidence. You kind of notice that if you look back, historically, that confidence kind of tracks what's going on with the market. That's really opened up into a fairly big gap right now between what's happening with consumer confidence and the overall market. So again, it's a bit of a conundrum as we kind of look at this. Now, so here's another question that they ask consumers. They say, what is your confidence in the economy today? And what is your confidence in the economy a year from now? And this is called current expectations versus future expectations. So we can do a graph where we basically subtract what you think about the future, and subtract out current conditions. So I'm optimistic about the future, and I'm not so optimistic about the current condition. So historically, when that ratio has reached very, very low levels, you've basically been nearing a recession. And then when it reverses sharply higher, as it just did, you've normally been in a recession. And normally at that point, when you get that reversal higher, markets are correcting. They're in that process of correcting. And because what's happening is current conditions were very dour. Future expectations were optimistic, and all of a sudden those future expectations start to collapse, right? And so you start bringing that ratio back in line with each other. And that's what's happening currently. Forward expectations are coming down for the economy, but it hasn't really registered in the financial markets yet. Markets are ratcheting all-time highs. And again, this is one of those recessionary indicators with an absolutely perfect track record, like the yield curve and everything else says, hey, a recession's coming, but there's no evidence of a recession. At least not yet. So this dichotomy between, and again, it's this. This is the interesting aspect about this, which is that you're talking to consumers and you're like, well, how do you feel about the economy? It's terrible. But man, I'm loving the stock market. Those two should somewhat relate to each other, but people are very optimistic about the stock market right now because why not, right? It's just going up. As I said earlier, it's just this massive flood of money that's just coming in, into the market. The flows are just immense. And so stock prices keep going up. So it just, how you feel about the economy is like, oh yeah, the economy's terrible. Inflation, can't find a job, blah, blah, blah. It's terrible. But I'm over in the stock market trading stocks, right? People haven't made that connection that those two matter. They relate to each other. So again, does this mean that, in the near future, we're going to see a sharp slowdown in earnings growth? Maybe. Maybe that's what that's going to tell us. And then at some point, in the next 12 to 18 months, markets are going to have to reprice for slower earnings growth. Historically, that's what this data says happens. But again, this has been a very unusual environment that we've been in because there's been so much of this artificial support and spending by the government, et cetera, that continues to drive economic activity, at least on the surface. So while consumers are certainly pressured, and again, when we take a look at the dichotomy of the market, right? You have 10% of income earners own about 90% of the stock market. The bottom 50% don't own anything, right? So when you're taking this consumer confidence poll, and if you're polling the people in the bottom 50%, they're like, oh yeah, man, the economy's terrible. What do you think about the stock market? Well, I guess it's doing fine because it's going up, but I don't have any money invested in it, right? For people who do have money invested, it's great. They're making money hand over fist right now. And we've seen these periods, in the past, but not to such a degree. That dichotomy that's currently going on between consumer confidence in the economy versus consumer confidence in the markets is one of the largest we've seen on record. Now, how that ends, I don't know. One will catch up with the other at some point. Either markets will catch down to consumer confidence or consumer confidence will give way and catch up with the stock market. But that gap will close at some point, and how it closes will be the interesting thing to watch. But again, that's not tomorrow, right? That's not tomorrow. That's not this week. It's not this month. It's not this quarter. This is something that we're talking about. Potentially, we'll find out, and we'll talk about it here in 2025. We'll at some point next year, we'll be going, oh yeah, remember that conversation we had about the consumer dichotomy back in, on October, and the last day of September of 2024. Well, here's what happened, right? So we'll and that's why we write these articles and publish them, so we can refer back to them. It's like, oh, remember what we said back here? Here was the end result of that. And how that works out, I don't know. And nobody does. And this is one of the big challenges for investing, is that if anybody tells you they know exactly what's going to happen, oh yeah, this situation is going to lead to this event in the markets, they don't know. Nobody knows, right? And if you had gone back in time and just showed me the chart of consumer confidence and said, what's the stock market doing based on what's happening with consumer confidence, I would have told you, oh, markets are probably down 40, 50% from their peak, because that's what happened historically, right? And that's the problem, is that, when you look at this data and go, oh yeah, well, that means this is going to happen. There are times that are different. Every time is different. Now, most likely at some point, these things are going to resolve themselves in one direction or the other. It could just be stagnant stock prices while consumer confidence catches up, right? I mean, it could just be that maybe we just don't go anywhere for a while. Historically, that hasn't happened, but that could be an outcome. Maybe just the rate of appreciation slows down dramatically while confidence catches up. I don't know. I don't know how this turns out, and trying to take a bet on how this turns out is the risk, right? Because if you bet wrong, that's where the risk is. All right, quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These
men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, a couple things just about the markets here real quick I wanted to kind of take a look at for a moment. So, a couple of interesting things going on. Earlier this year, we were talking a lot about the market in terms of breadth. And it was all about AI. And we wrote several articles looking at the breadth of the market, talking about how, well, it's basically 10 stocks kind of driving the whole market, 7 stocks. And the rest of the market was really underperforming. Well, since then, and Brent, you can bring this chart up for me. Since then, that breadth has improved to a good degree. And you can kind of see, so the shaded area behind, if you're driving, don't try to look at your phone. I'll explain it to you. It's a chart of the S&P 500, and behind it is a shaded area that is green or red, depending on whether it's increasing or decreasing. That's money flows. And, of course, back in July when the market started to have a correction, and remember, back in June, July, we were talking about, hey, we're going to have a 5 to a 10% correction here this summer. Just be aware of that because we've got extensions, deviations, all the things that we talk about. It's just, we had this perfect setup for a correction. And, money flows were extremely positive. And those began to reverse and deteriorate pretty quickly. And then, of course, we got into as that money flow reversed, we got into a market correction that led up to the kind of yen carry trade blow up. Since then, those money flows have reversed, but what's notable is that while markets are making all-time highs, money flows are actually not nearly as strong as they were earlier this year and have started to kind of tailor off here just a bit. Now, again, they're still positive, and this is why we talked about the negative divergences in relative strength and momentum. Because despite the markets making all-time highs, relative strength is actually weakening. Momentum is actually slowing down here a bit, which has historically kind of preceded short-term market corrections or consolidations. In other words, this advance in the market, which has gotten very kind of lofty very quickly, should probably slow down here to some degree, maybe have a bit of a correction here, a pullback towards, the 50-day moving average would not be surprising. But note that the breadth of the markets, the number of stocks that are participating and are above their 50-day and the 200-day moving average have both improved markedly. So this time, this rally has been a bit different than we saw earlier this year because it's a broad swath of stocks that are all kind of playing in the markets right now. Finance, utilities, real estate, tech, staples, discretionary. They're all kind of participating in the market. And, it's kind of what we talked on, a little bit last week, and I discussed with Adam over the weekend. It really doesn't matter what you own right now. It's all going up. And you've got a very high correlation between asset classes, whether it's stocks and, Bitcoin's up 54% this year. Gold and stocks are up 20-25% this year. So again, you've got very high correlations between asset classes really across the board. If you own bonds from earlier this year, you're doing well in bonds. So again, it hasn't really mattered where your money was. And this is that exuberance. This is that push in the markets that we were talking about. Everybody's just like, oh yeah, I'm buying it because why? Well, it's going up, so I'm buying it. And of course, more buying begets more buying because traders on Wall Street have to basically, somebody's got to sell you the shares, right? So they're executing the trades and then they're taking those, the other side of this is that retail and institutions alike are taking this process further by really pushing out an options bet. So they're leveraging their bets through options across all assets. So this is all leading to this very market can you bring that chart back for me? I'm not quite done with it. Actually, just hold on a second. Let me give you a different chart here. Because we're now getting to the point to where we've had this kind of very strong move in the markets really across the board. And we've now reached the point to where, and this is the interesting thing about breadth, when you have very, we have a lot, I'm trying to say how I want to say this, but when you have assets across the board all participating at the same time, and you're at very high levels of breadth and participation, as we are now. And what I've got up now is a chart of the S&P 500, and there's relative strength at the top, and at the bottom is the breadth of the market. So it's the number of stocks above the 200-day moving average and the number of stocks above the 50-day moving average. So the point here is that everybody is in the market. It doesn't matter what the asset is, everybody's buying it because why? It's going up. And you can apply your thesis to it. You can say, well, this is going up because of this, but it's every asset. So whatever your thesis is, doesn't matter. Money's chasing money right now and pushing these assets prices higher. And this is something we're going to discuss a little bit more in depth tomorrow, but we've got this big push of money. Well, note that whenever you have very high levels of participation, that has typically coincided with short-term market peaks and corrections. Again, that doesn't mean massive corrections, right? I'm not talking about 50% drawdowns. But you typically have a period of consolidation or correction to work off some of the exuberance. And that's really kind of the point. And this goes back to our conversation in the earlier part of the show about consumer confidence in the stock market is extremely elevated. Everybody is super bullish the markets. And so when everybody is on one side of the boat, it doesn't take much to kind of shift prices in the other direction because all it takes is one person to go, you know what, I'm out. And so they sell. And then somebody else goes, well, why are they selling? And then a couple other people say, well, maybe I'm going to get out too. So they get out too. And all of a sudden, you start to have more sellers than you have buyers. And when that occurs, then you start having a contraction in the markets. And again, as we've talked about so many times here on the show, is that, sellers live higher, buyers live lower. And that's because as long as sellers can sell at a higher price, they're dragging the buyers up. They're like, okay, well, you bought the S&P at 5,700 last week. I'm going to, you can buy it from me today at 5,750, right? And so it kind of drags prices higher. Well, at some point buyers go, I don't want to buy it there. And so the seller goes, well, okay, well, how about 5680? And the buyer, I don't know. All right, how about 5750? Oh, okay, yeah, whatever. And so it becomes this negotiation in the markets. And as buyers start to contract, and again, buyers live lower, They're like, yeah, I'll buy it from you, but you're going to have to bring the price down to here. Just think about it like if you go to a flea market, right? Have you ever been to a flea market? Brent has, yeah. Back when I was growing up, I grew up in this little bitty town called Lake Jackson. And there's probably a total of 20,000 people that lived in this town. So there wasn't a lot going on. Let me tell you how boring this town was. This town was so boring, they didn't even really worry about naming streets. They named the streets this way, that way, circle way, anyway, and which way. Okay, so this is a true story. There's still today, you go down to Lake Jackson and those streets are still there. So, but there wasn't a lot to do. So on a weekend, everybody would kind of get together and they would drive to Pearland to the flea market. Right. That was a big day out. Now we're talking about 400 years ago. So it was like we were all in, wheelbarrows and carts with, horse-drawn carriages, right? And so you all go to Pearland, you'd hang out and you go to the flea market. And the whole fun of the flea market is you go find some piece of crap that nobody wanted anymore. And the guy said, yeah, I want $10 for it. And you're like, well, I'll give you $9, $8, whatever. And then the whole fun of it was trying to negotiate so you could leave with somebody else's piece of crap that nobody wanted. And you say, I got a hell of a deal on this thing. I chewed the guy down to, $8 on this rusted wheelbarrow that I bought. And I'm going to go home and fix it. I'm going to go home and spend $30 fixing it up. But hey, I got it cheap, right? That was the whole beauty of the flea market. It's the same thing in the stock market, right? Everybody's going to the stock market every day and they're negotiating prices. And the question is at where and at what point do buyers stop willing to overpay for stocks? And that's where you get your correction. But again, when that occurs, how it occurs, what causes it to occur, you need some event, right? And sometimes you don't. I mean, sometimes literally for unknown reasons, somebody will just say, I'm out. And then it just kind of starts a cascade of sellers. And particularly through the options and futures markets where, gold, commodities, et cetera, all trade on NYMEX. And that's what sets the price for all commodities. And so at some point, options traders, future traders just go, yeah, I'm out. And prices come down for whatever reason. But sometimes there is a reason too, right? And, we're going right now through a big period of time. As we talked about earlier, you've got the largest amount of shorting in energy stock or energy futures, oil futures, that we've had in 5 years. So that's what's dragging the price lower. As everybody's shorting the price of oil, that's dragging the price of oil lower. Well, at some point, somebody's going to say, I'm buying that. And then all of a sudden, all the shorts have to cover. And you get a big surge in oil prices. Just take a look. A good example. Look what's happening in China, as we talked about earlier in the show today. China's a great example of this. Chinese tech stocks just getting absolutely decimated. China comes in and says, I'm going to buy that. And they're up 40% in a week. Right? That's all short covering. Right? That's everybody that got caught on the wrong side of that trade. And this is why it's always important, no matter what your thesis is, take profits when you have them. Because it will reverse. And when it reverses, it tends to reverse rather sharply. All right. Wraps up the show for today. Thanks so much for joining. I actually had a Plymouth Fury 3 when I was growing up. I was in chat. EC says he had one. All right. Great show today. Be sure and like the channel. We certainly appreciate it. It certainly helps us promote our show out on through the Google algorithm. So please click the like button and enjoy us. And get by the website, realinvestmentadvice.com. Send your questions, comments. Let us know what we can do to help you. realinvestmentadvice.com. Have a great day.